Hey, this is Sasha. Thanks for joining me here for another episode on Traders Fly. And what I want to do is share with you how you can go ahead and make consistent money each and every single month by selling option premium, known as the covered rights or selling covered call strategy. Now, I'm going to also show you at the end of the video a little bit of a better alternative as well. But to get things started, let's at least hone in and understand the basics first. All right, so let's take a look. All right, so if we look at a covered call strategy, the way that this works and really the big goal behind it is to make money every month. You could do it every 30 days. You could do it every 45 days. Whatever you decide is totally up to you. But anything above 60 days, you could do it, but the theta decay is a little slower. So what you understand is options do decay, and that's what you're really doing is you're selling insurance on your stock. So in order to execute this strategy, you have to start out with 100 shares minimum of stock. And that is because one option contract then controls 100 shares of stock. So what you're going to do is you're going to go ahead and sell one call contract while you have 100 shares of stock. And what you can do is you can go ahead and get it close to 30 days when the acceleration is really quick and it decays. And you could go further out. Now you'll make more money if you go further out, but the decay is slower, right? It starts slower and then it picks up speed. But in this case, you can get wider, so there's always trade-offs, but this one you'll be tighter to your strike price. So the way that it really works is, okay, normally you have a stock, you make money as the stock goes up, you lose money as the stock goes down. Now with this strategy, what you're doing is you're gonna be adding in a little flattened curve. So let's say your current price is right here. So here's your price. Eventually stock price goes up, and then if it goes too far past it, well, you just lose your stock, but you still keep the premium. But you lose your stock at a higher price. So that's really the big downside with this, is that when you have 100 shares, okay, you have 100 shares of that stock, and then what you do is you sell premium on it month after month, and eventually it's going to go past that premium price. And when it does, you'll lose your stock, but you get money for it. In other words, you sell it at that higher price, but you've continued to collect that premium month after month, because we know and understand stock prices don't go up really forever. So when I look at this example here, we're going to go ahead and do it with, let's just do something small like Twitter. And just to give you an example right here, Twitter is $29 right now. So I need to go ahead and buy 100 shares of Twitter to make this work. And in order to do that, I'll go ahead, analyze the trade, and I'll just show you. This is what the profit risk profile picture looks like. So when you see this, here's your profit and loss. There's your zero line. So that would be my current price right there. And here is the price of the stock wiggling around. So when you look at this, what you can do now is normally you just go ahead and make money as the stock price goes up, but you know that, hey, these things don't go up forever. Sometimes they pull back. So wouldn't it be nice to make money every single month? Well, that's what the covered call strategy does. And here what you can do is there's these option contracts right here. You've got calls on the left, you got puts on the right. So you can see right here, here's the call side, here's the put side. So where the heck do you go ahead and sell these things? Because the whole goal is selling these things. And what you do is you say, hey, well, right now the current price is $29 on this stock. Well, if I sell it at 31, chances are I'm going to lose my stock. And it comes down to, what do you want to do? Do you want to sell this thing every single month and make money and still keep your stock? Or are you okay, hey, if the stock gets sold at that higher price, I'll just rebuy it again and just continue to do this for the rest of my life. You could do that as well. So it really just depends on what your end goal is. Now, if I want to go ahead and let's say I don't care if I lose the stock, I could go ahead and look at something of a probability of, let's say, 10%. That this will be, worth anything at expiration. I could go ahead there, or 16%. If I'm not too worried about losing the stock, or really if you're not that worried at all, you could go at 25%, and you'll see these percentages right here. So what I'll do is I'll go ahead and right click, I'll sell, and I'm just going to go ahead and sell a single, and you'll see that I get 48 cents for that. So what this did was flatten out my curve right here. So at 31, that is the strike price I'm selling at. At 31 dollars is my strike on December 20th, 2019. So that means if the stock is above $31 at that time, I'm going to go ahead and lose my stock. Now, I'll lose it at $31. And the great thing about this is I'm still going to make a profit from the stock. So, hey, if that stock stands still, what's going to happen? Well, here's my call that I'm selling. I get to make 48 bucks, right? Now, it doesn't seem like a lot, but let's say you multiply this times 10 contracts here, okay? And let's say you had, 1,000 shares. All of a sudden now, you make $480 if that stock didn't hit $31 a share. Well, that's great. Now, the problem with just selling naked calls is, of course, well, the losses can continue to accelerate. That's why you have the stock. So when you have the stock right here, okay, I sell it at 31. Well, let's say it goes to 30. Well, if it goes to 30, it's still under my 31. I still make my $480, okay? If it goes to 33, I still make my $480, but I lose my stock at that 31. So I could have made probably a little bit more, but hey, you can't win them all, right? So what you could do is with time, let's say this stock goes up to 30, well, you collect your $480. Then you go ahead and just keep your stock and you do this again. In January, you continue this process. Then you do it again. In February, in March, as those things continue to come up, you continue to do this process. And that's really the way the covered call strategy works. And if you look at that profit picture, it looks just like this. And there's going to be an alternative I'm going to show you here in just a minute. But if the stock price goes down, this is the cool part about it, is normally, hey, if it goes down to 28, at least you made 400 and, well, let me go ahead and bring it back to our December. At least if it goes down to 28, I still make my $480, because here you could see my losses would be right around $8.98 with the calls. But if I didn't have it at 28, I would lose about $1,176. So if the stock pulled back $1. So that's the other advantage with selling covered calls, is even if your stock pulls back a little, it cushions you. So number one, you make money from if the stock stands still. Number two, it cushions you if the stock pulls back a little. Number three, if it goes up just a little bit, you still get to keep your premium and keep the stock. But number four, the situation is, well, if the stock does explode, that's kind of where this doesn't work out as well. Well, in that case, you lose your stock at the strike price, but you still get to keep the premium. So you're still winning, you just lose the stock, you can rebuy it and do the process again. Now, if you want to really, really keep the stock, of course, what you can do is go really far out, but you get less premium at these prices. If you're not worried about it too much, well, you could go ahead and sell closer. You make more money, but chances are you'll probably lose your stock. So some people, what they'll do in about, let's say if you did this for 12 months, maybe in 12 months, let's say 8 of them were a win and you keep the stock. But then maybe the other 4, you still got the premium, but you lost the stock. So sometimes it could work out that way, just depending on where you're selling, depending on the market. But nevertheless, you're making extra money and income. And this is a great alternative if the stock isn't paying a dividend, because it's kind of like making a dividend. And if the stock is paying a dividend, you kind of got double dividends here by doing this strategy. Now, here's an alternative I want to share with you, is that notice this profit picture. And this is something we cover more in some of my advanced courses that you can check out. Check out some of the courses and books we have on our website at tradersfly.com. And you can really learn a lot more about options and option trading and a lot of other great stuff that we have. But if you want an alternative, here's kind of an interesting twist to it, is if we buy a diagonal, and I'll show you, analyze this trade right here. And we'll go ahead to January, and I'll go to, let's say 31. Let me zoom in a little bit for you here. And we're gonna flip this to the 30 and do this one at 31. And what you'll see is that this is a very similar strategy. You can see, hey, you still have an upward direction, and then you have a flattening of that curve, and it uses a lot less capital. So here I'm putting on a trade for $80 that you can see, compared to buying 1,000 shares of Twitter at $25 is much more. And I could go ahead and stack this, add a couple contracts, or I could go ahead and take this to maybe 29 and do a 31. And now you could see, hey, that's actually very close. So take a look. I could go ahead and just risk about $360 on that trade, and look at the profit picture. Look at what it looks like. It looks very similar to the profit picture of this by using less cash, by just dealing with the options themselves. So you can see right there the power behind it. Anyways, I hope you found this video helpful, insightful, gave you some things to think about. Definitely subscribe to the YouTube channel if you want to see other great videos like this, or join the newsletter list. And of course, check out the website at tradersfly.com, where you can see some other great educational courses on options, more strategies like this, and how you can make more money as you continue to invest in the market. Thanks again, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.